A bond sell-off can have a significant impact on various parts of the financial system, including banks, insurance companies, pension funds, and more.
Join our YouTube community. Be part of our YouTube journey. Subscribe now. Get exclusive content, stay updated, and join a community of like-minded enthusiasts. Please subscribe for $1,000 early bird draw.
U.S. banks, especially smaller ones like Silicon Valley Bank, can face vulnerabilities as a bond sell-off leads to paper losses on their bond portfolios. European banks, although somewhat mitigated in the first half of the year, are expected to see the impact on their Common Equity Tier 1 ratios as they report their third-quarter numbers. Insurance companies, which hold bonds to back liabilities like pension obligations, can face challenges as rising interest rates prompt policyholders to cash in long-term products, forcing insurers to sell bonds at a loss. Pension funds, despite higher yields on government debt benefiting their funding positions, may encounter collateral calls due to rapid rises in yields, forcing them to sell assets at potentially lower prices. Corporate debt markets can see increased borrowing costs for companies as government bond yields rise, particularly impacting riskier borrowers. Private equity firms may face challenges in financing leveraged buyouts as higher interest rates increase debt costs, impacting both deal-making activities and portfolio companies' debt servicing capabilities. Private real estate valuations may come under pressure from rising long-term interest rates, potentially leading to property market revaluations. The broader financial markets can experience increased volatility due to bond sell-offs, affecting various asset classes and financial market stability. In the financial sector, major banks are gearing up to report their quarterly earnings. J.P. Morgan Chase CEO Jamie Dimon has warned of a worst-case scenario involving 7% interest rates and stagflation, emphasizing the importance of preparedness. KBW analyst Christopher McGrady recommends an overweight position in J.P. Morgan Chase. Wells Fargo, while having higher earnings outlooks, saw its stock decline in the third quarter. Citigroup is expected to report lower earnings amid CEO Jane Fraser's restructuring efforts. Bank of America's earnings are expected to be slightly lower, with high revenue expectations. Goldman Sachs achieved a modest gain in the third quarter but is expected to report lower earnings. Morgan Stanley's stock fell, and it may provide insights into its pending leadership transition. Despite concerns about rising interest rates, some industry players remain optimistic about a mild recession and an economic rebound, particularly in deal-making activities. Additionally, a massive healthcare strike involving 75,000 Kaiser Permanente workers aimed to address low wages and staffing shortages but concluded without a resolution. Rising mortgage rates are impacting the housing market, potentially leading to a 13-year low in home sales. However, some buyers, such as those relocating from expensive areas, continue to drive demand in the housing market. Both the Canadian and U.S. economies have reported unexpectedly strong job gains in September, which could pose challenges for central banks grappling with inflation concerns. In Canada, the economy added 64,000 jobs, significantly surpassing the expected 20,000, while the unemployment rate held steady at 5.5%. And hourly wages rose by 5.3% year-over-year. Similarly, the U.S. recorded job gains of 336,000 in September, double the median estimate. These robust employment figures are causing central banks, such as the Bank of Canada and the U.S. Federal Reserve, to rethink their strategies. They are now facing increased pressure to address inflation by potentially implementing more interest rate hikes. While these strong employment numbers suggest economic strength, some economists warn that beneath the surface, there are signs of softening hiring demand relative to an abundant labor supply, which could complicate the central bank's decisions. The concern primarily revolves around rising wages, which are seen as a persistent factor contributing to inflation. While the economic outlook appears strong, uncertainties remain, including factors like the ongoing COVID-19 pandemic, making it crucial for central banks to strike a balance between supporting growth and managing inflation expectations. The upcoming economic data and central bank assessments will play a significant role in shaping future policy decisions regarding interest rates and inflation control. The recent surge in bond yields has sparked concerns in financial markets, reminiscent of the 1987 crash. Saxo Bank's CIO, Steen Jacobsen, attributes the increase in yields to government's unrestrained issuance of debt, pushing up the cost of capital. Jacobsen anticipates central banks, including the Federal Reserve, discussing potential rate cuts in 2024 and possibly implementing yield curve control to cap long-term yields. In response, Jacobsen advises investors to reduce risk by increasing cash balances, hedging portfolios with index-linked ETFs, rotating into short-term bonds, favoring defensive sectors over cyclicals, and avoiding overexposure to mega-cap stocks. Low water levels in the Mississippi River are causing concerns for farmers and the barge industry. T.D. Cowen warns that grain shipments may be shifted to rail and truck due to the low water levels, potentially leading to higher freight costs. While there is capacity on both modes to handle the increased freight, truckload rates remain stagnant. The Mississippi River's gauge height at St. Louis has fallen significantly, hampering river shipping and raising costs for barge companies. Additionally, low water levels have led to saltwater intrusion into the river, impacting water supplies and requiring emergency measures. During these times of uncertainty, one may think of thematic investing strategy that enables investors to align their portfolios with broad global trends, ideas, or values that may span multiple sectors or industries. It offers two primary avenues for individual investors: thematic exchange-traded funds, ETFs, and mutual funds, or direct investment in a group of stocks related to a chosen theme. Thematic investing has grown substantially in recent years, with numerous thematic funds available, but investors should conduct thorough research before selecting them. While it allows investors to pursue growth opportunities and values-aligned investments, it's essential to consider risk tolerance, investment horizon, and broader financial objectives when incorporating thematic investing into a portfolio.
Buying good stocks can be a good investment for several reasons. 1. Potential for capital appreciation. 2. Dividend income. 3. Diversification. 4. Liquidity. 5. Ownership and voting rights. 6. Historical returns. 7. Inflation hedge. 8. Professional management. 9. Tax benefits. 10. Accessibility. It's important to note that while investing in good stocks can offer significant advantages, it also carries risks. Stock prices can be volatile, and there is no guarantee of positive returns. To make informed investment decisions, it's essential to conduct thorough research, consider your financial goals and risk tolerance, and, if necessary, seek advice from financial professionals.